Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McClain, thanks for joining us.
Yep, glad to be here with you in this mid-September. It's interesting.
But you still have children at home, so...
I was thinking about the markets, not about...
Oh.
With the markets,
Yes.
I just remember for a long time it was October is supposed to be the bad month. Now they say September is the bad month.
I saw two articles. I don't even...
Well, it's all noise, and who cares?
Yes.
But clearly we have some more volatility this month with markets, big swings.
Okay.
Okay.
Truly. It's a risk premium. Everyone needs to understand that. The reason it does better than treasuries is because of the volatility. If there was no volatility, it wouldn't have been any better than treasuries. It's a risk premium. No? If it only went up, there'd be so much money in it.
Well, everyone would bid the prices of these companies up so that all the excess return was already squeezed out of it.
That's right.
Point. Yeah. But it's such an interesting... Investing's a really interesting experience because on the one hand, we need to do all this research, do all this analysis, right? Which is important. But on the other hand, it's the biggest risk is ourselves and how we react and our emotions and following the headlines and the fear of missing out when our neighbor's talking about making money in something and we're not. And it's all those other things that are tied to it. Then you sell an investment and you feel guilty because the thing went up and then you're kicking yourself. Why'd I sell that? I feel like an idiot.
Yes. Well, I think that...
I should have bought that. How many times have you heard that? Gosh, I would have bought that.
Well, we live our lives that way.
Right, I know. I was talking to someone, they were like the fifth generation of have a place on the lake in Lake Tahoe. I'd met this couple. Fifth generation. Their great-great-grandmother, what it was.
5 generations.
Someone bought the land in 1920.
They were rich then, by the way.
Okay, that's my point. It was only $200 for the lot. I'm like, who had $200 in 1920? I mean...
Yes.
It wasn't like, oh, I've got so much money, why don't I just go and buy an extra lot?
My mother was the king of that. We would drive down the street, and she's like, if we had bought that 20 years ago, and I'm like, Mom.
You had no money, like today.
20 years ago, we were talking about putting gas in the car.
We couldn't afford to fill up.
Yeah, do you have this special trust fund we weren't aware of?
Yeah. But
if you had a house on Lake Tahoe at any point in your life, in generations, you
That's
were
right.
above average.
Of course, yes. Even when it was not quite the spot. Anyway, it's but with the volatility comes all these different articles about is it the right time to invest? Be careful. It's the overheated stock market and protect. Like,
are the interest rates going to go down 0.25% or 0.5%? That's the big one.
Who knows?
That's right. And
you think over the next 20 years it's going to make any difference in your life?
That's right. And by the way, it's not like the Fed knows. They actually go in and argue about it. It's not like they all walk in with a predetermined, it's going to do this. They get into a room and they throw numbers around and make arguments for their side or against their side.
As long as the economy continues to grow and companies are productive, the prices of those companies will continue to rise.
Well, Scott, I did read an article today that said both Harris and Trump are very interested in a sovereign wealth fund for the U.S. And
we don't have any wealth. We got $33 trillion in debt.
But don't we have a sovereign wealth fund already? Wasn't that what the CHIPS Act was?
CHIPS, Inflation Reduction Act.
Weren't those?
There's trillions of dollars that we're allocating around.
Was that not what a sovereign wealth fund would do?
Aren't sovereign wealth funds for countries that have excess reserves and need to put it somewhere?
That
primarily Saudi Arabia. Like there's not that many countries, with sovereign wealth funds.
Correct. Well, there's Norway has a sovereign wealth
oil.
fund. It's oil. Alaska actually has oil.
Right. They have so many natural resources. They have excess reserves because their natural resources are in high demand globally.
Yes.
And they got to put their money somewhere, and that's why they have those sovereign. So why in the world would our politicians want this?
In order to influence behavior in the marketplaces for strategic purposes.
Idea.
That's what I thought.
What a bad idea.
I read the article this morning, and I thought,
you look at the CHIPS Act.
What was that?
They're a little late in the game, and it wasn't AI chips that the taxpayers are putting money towards.
Yes.
Billions went to Intel, and Intel's laying off a bunch of people now.
It's perplexing.
No, it's how the government works.
Okay. Well, it's still perplexing.
I don't like the idea of the government getting involved in most things.
I don't know how
they don't seem terribly efficient.
How did we get on that conversation? But anyway,
the sovereign wealth fund.
The sovereign wealth.
I think you need wealth before you have a sovereign. To the same point about buying land, had we not bought that, our country has no money. We have $33 trillion in debt. Are we going to borrow another couple trillion just so we can go play around and see if we can figure out who the next Steve Jobs and Elon Musk is?
You've got to respect my mother's bright-eyed view of the world. That was, like we could have done that. Okay. Hence, living in the past about your portfolio. It is what it is. And remember, the portfolio is not doing anything. It did. The mere fact you can measure the returns on a portfolio tells us it's historical.
And in theory, the prices are set based upon all relevant information today. The markets probably are more efficient today than ever with the flow of information.
And the regulatory environment in which we live.
There's less cheating.
Less cheating.
However you want to call that. And so the only reason things are going to change if there's new information that's brought to the market. And if it's new information, we don't have that information. So how do you make a decision on something we don't know about?
Which is build a good portfolio.
Which is so much, Pat, is based upon really two factors, right? Time horizon, that is, when do you need the money? And secondly, how much can you stomach the ups and downs? And like I remember years ago in the dot-com boom, because the craze feels a little similar in the AI, although not to the extent of, not nearly to the extent of the
No.
That was crazy.
I mean,
time.
You could come out with anything called
I remember
.com.
talking to a guy, he had his property tax money that he was going to pay in April, whatever your property taxes are due, the second installment, his property tax money in a .com fund. And he was telling me about it. And I looked at him and I said, you need to get that money out of there now. He said, what do you think? I'm like, I don't know what's going to happen.
It's not that.
But your time horizon is 2 months.
Yes, that is not the time.
So a time horizon, like, if you've got money if your kid's a senior in high school and you've got money in a 529 plan that you plan on using next year, probably not a good idea to have in the stock market. On the other hand, if your kid is 2, bad idea to have it in bonds.
So not only that, so we came in last Friday and we took a bunch of calls that we used.
Yeah.
And when I was leaving the office last Friday, I was thinking a lot about it. About half the calls, we answered questions that people didn't ask. They asked a question and we dug a little bit deeper, and they were looking at a specific instance in their lives, and we try to look at things holistically, like how does this fit into your overall life?
That's right.
And their question is, well,
about whatever.
Right, whatever. Which is, look, your portfolio is just part of your financial life. Part of your financial life. It's not your financial life. It's part of your financial life.
Well, and for most people, the more you pay attention to the daily news and the news feed and watch the stocks ticker on your phone throughout the day,
Or
and
look at
read
your
the
portfolio.
headlines, look at your portfolio all the time. Studies show it's just not that. It's fun to do when things are going up. Wow,
Yes.
look how much money we made this month. Not so fun when things are going down.
Yes.
Anyway,
Risk premium.
yeah. And Pat, you mentioned calls. We love taking calls. We schedule our calls ahead of time, and frankly, it's our favorite part of the program. And we appreciate when you call.
So
us.
what happens is you call someone. We'll schedule time. Well, we're in the studio to take you.
Yeah.
We call you. You get on the air.
Just like if you're going on Judge Judy, it's scheduled ahead of time. They don't take calls on Judge Judy. Who do they take calls on? Whatever the case.
I don't know. I don't know. She's done okay.
Judge Judy?
Yes.
She still have a show?
I don't know, but she's done a bunch
I don't think I've ever actually watched it.
You haven't.
No. Now I think about it. I've never watched Judge Judy. I've seen it like walking on the gym or at the airport or something. I've
watched
from a
it.
distance.
I'm
but
a
I've not-
fan. I'm a big fan.
of Judge Judy.
Yes. Big
Is it
fan.
like a binding arbitration that people agree to
It
as they
is a
go
binding
in?
arbitration. And actually, sometimes she actually takes the money. They pay you an appearance fee, but sometimes she'll take your appearance fee and use it to pay the
If you're such
the
a bad actor.
the prevailing party. But I like it because I just think most of it's just not really. Some of it's rooted in law, and she'll tell you this is rooted in law, but most of it's just kind of common sense. Like,
All right. We don't need to talk about
well, we're going to do a little review of Judge Judy and her spinoff shows.
No, we're not. Okay. So anyway, if you want to be part of our program, questions@moneymatters.com is our email, questions@moneymatters.com. We're starting off with William. William, you're with Allworth's Money Matters.
Hey, how's it going?
Wonderful.
I had a question for you. I'm considering retiring. I'm not working, so I was thinking of just staying retired. I'm 60. But my bigger question is, what are the considerations you retire? So you got Social Security coming up. I have a pension. It's a retirement fund, so it's a defined contribution, and that grows at about, the payout is like grows at 4 or 5%, and then I have about 900 in retirement, which is some in about 100 grand in a Roth IRA, about 400 in a regular IRA, and the rest is in just a regular investment fund, like a taxable fund.
Okay.
And so now I'm just confused. Like, so say I retire today. When should I start? What money do I start taking? What fund do I start taking money out of? Does that make sense?
And,
So I could take the retirement from my employer. That it's not much. It's like $1,400 a month, but I could wait 10 years and it'll grow at 4% guaranteed. When I turn 62, I can take Social Security, or I can wait and get 8% guaranteed, or some sort of combination out of my investment. So I'm really not sure what to consider.
Yeah, and there's a lot of variables here. One variable, obviously, is tax rates, right? So,
And the biggest variable is how much money do you actually need to live? Do you know the answer to that?
Yeah, that's second. But
Right,
even if you've got enough money to live, the number of variables on where to pull the money out, taxes is a huge consideration, and it's because our tax rates are progressive. The higher income, the higher the rates are. So if we had a flat tax, it'd be pretty simple, but we don't. We've got a highly regressive tax rate and progressive tax rate. Secondly, one of the factors is your own investment experience and how good a job you do at investing. I mean, I've seen people that they react so much and make so many changes to their portfolio. It's like, maybe having stuff in a fixed annuity is your best bet because you're not. And other people, it's like you've had such great experience in the way you weather the markets and your lack of fear of the markets that enables you to have much more leeway and maybe we'll let those dollars grow for a longer period of time than we would have otherwise.
And with you, it depends on that defined benefit pension plan is what you have that grows at 4%. A lot of that is based on your health. If you're in poor health, you want that as quickly as possible.
But the bigger question, to Pat's point, is whether or not you have enough resources. So you might be able to figure out how to retire today at 60, 61, 62, 63. What happens when we're 78, 84, 89? Right?
So
Yeah.
how much money are you married?
No.
And how much money do you need to live?
Right now, I live off like $2,000 a month. I have no debt, house paid off, cars paid off. So the only thing I worry about there is another thing on the income side. You have to watch your income because of to get insurance, have some subsidized medical insurance.
That's right.
So the higher you make,
it's another
the
variable.
more you have to
That's
pay
right.
in that. So,
That's right.
Which is, to be honest, the only reason I can consider retiring. Otherwise, you need another $1,000, $1,200 a month just to pay.
We understand
insurance.
it is a technique, which is you artificially impoverish yourself
to get
for
on
a period of
Obamacare
time in order until you qualify for Medicare. Right, and that's something.
That's what my plan is now, is to keep it low enough to get subsidized, because I can do that with the different.
That's right.
That's right. That's exactly
100%.
right.
You've got all that money in
And so if
brokerage.
if you end up doing a bunch of Roth conversions, you would have a higher taxable income, which would cause your premiums to maybe go to $1,000 as opposed to $50.
So
don't you need income salary to do a Roth conversion?
Not a conversion. No, you can convert today.
Oh, whether you're not making any money.
that's
Okay.
correct. That's
Yeah.
correct. So
And had you said I have medical from my employer, we would probably be having some discussion about that. And it still might have some discussion about that.
but from my view, right?
Well, what was your salary last year? How much income are you earning?
It was like 70.
And did you save a lot of that?
I saved it as much as I could. We had a simple IRA, so I maxed that out, which I can't remember whatever the max was.
Wait, excuse me.
20.
You used the word "we."
I made the company had a.
Thank
Okay.
you. Okay.
Sorry.
Thank you. Thank you. So my guess is, a financial advisor could do this. My guess is because you've got this experience investing, I assume that, have you reacted to the markets negatively or positively in the years that you were able to save this $900,000?
Yeah, I wasn't. Well, the IRA money was some of that money was rolled over from a 401k when I left the last job, but that money was more in some fund, like mutual funds.
And how is your cash? So you've got $400,000 or $500,000 in outside investments. How are those allocated?
In the IRA or in
The brokerage.
Okay, the brokerage is. I think I forgot what that. I thought it was like about $250. Those are mostly in individual stocks, and at some point I like to get out of that, but the risk there is there's lots of stuff I held for a long time that have big gains on them.
Yeah, embedded gains. My guess is, and a financial advisor could do this, but from the back of the cocktail napkin, I would look at taking that $1,400 a month and see if you could qualify for the subsidized medical care, and then drain off the brokerage account to make up the difference.
Okay.
Right now, yes.
Right now.
And mainly because of the medical premium.
Yeah, he's 60.
Yeah.
Right? So we've got a lot of runway there.
Right. You got like 5 years to maneuver until you get on Medicare.
Yeah.
Medicare.
Yeah.
But how confident are you that you're not going to go back to work?
If I went back to work, it'd just be maybe part-time.
And would you have more confidence if you had your pension coming in?
That's part of me thinks that I would be more comfortable. At least you'd be getting money every month, because I would. Every time I look at the retirement, you think, well, I don't want that to go down, which is the whole point of the retirement. You're going to use it up, but I'm an accountant, so you don't want to see that number go down.
It will go
that's
down.
the whole point of it. Yeah, that's the point of it. But
Emotionally, it's hard.
Yeah. And particularly once you retire, because now the future's here, and now we have to live on these dollars.
So as little as we know about you,
yeah,
I would probably look at the 1,400, make sure that it still doesn't hit the threshold. And I don't know what the threshold is. And I think it's different state by state or area by area.
Yeah, it's the subsidy floats. I don't know what the right term is.
That's right.
So you don't have to make. It's not Medi-Cal, so you just have to make under a certain amount. So I plan to take more income to make sure I'm over the Medi-Cal number.
But still qualify for the for the
Still qualify for
subsidies.
covered California.
Yes. So my guess would be that I'd start with the $1,400 and make up the difference with the money in the brokerage account.
Okay.
Scott?
Yep.
Yep.
Totally agree. Yeah, I would try to keep that. I'd run your account and I'd run the numbers each year. But the big thing for you the next few years is your subsidized medical.
Massive.
Yeah.
Right.
Yeah, it could be $12,000 a year.
I know people that are worth millions.
Yeah.
that get it.
Yeah.
Yeah, it's just a matter of it's just a matter of your income.
Correct.
The problem is if you if you do a Roth contribution, that still shows on your 1040. So it's
a Roth conversion. A Roth conversion. Yes.
Yeah. Sorry.
Yeah. So that's
Roth conversion doesn't make sense for you.
Makes sense for you.
Not only that, it's not like your IRA is so large we are worried about required minimum distributions.
No.
Right.
So that's the direction I'd go.
Yep. Totally agree with Pat.
All right.
So, all right.
All right. Well, hey, I guess officially you're retired today, huh?
Yeah.
Which is interesting. Thanks for the call. Thanks for the call. I was with my brother-in-law and his husband this last weekend, and they were asking me about where was I going with this? What were they asking me? Oh, about these Roth conversions and how they work and whether they should do them or not. And it's like, it depends on the year.
Completely.
It completely depends on the year. And what happens to this medical stuff? And you're like, well, it depends on the year, right? But it's crazy.
So to your point, you're talking. You mentioned the sovereign wealth funds, and the whole government get involved in things, and I don't think these subsidized medical was designed for people with assets.
No,
right?
No,
but it's all based on income. So if you've got the ability to have money that doesn't produce much in the way of income, have tax deferred, you own stocks that are going up in value, just pay up a little bit in dividends, not much.
You turn it on, you can turn it off. Yes. Do you feel bad ever
about what?
Giving that advice to people?
Well, a lot of what we do is minimizing taxes, is it not?
Yes. Or getting subsidies.
Or getting subsidies. We've got a phenomenal tax analyzer, the Holistic Plan that our advisors use. You can take a tax return. It's amazing what technology is, like how things have progressed. Take someone's tax return, scan it in, it reads everything, puts it all into a system. So it just
makes it easy to work with.
System, no one has to input it, just system uploads it automatically. And then with all the different credits and phase outs, it calculates it all in, and you can do a lot of different what if scenarios. So you can say, well, if my income goes to this, how's this going to impact other?
Yeah.
And I don't know if Covered California is part of that.
Is that what it's called?
In California, it is.
Yeah.
I don't know what it's called in other states or what it.
It'd be curious if they called it Covered California. Let's say.
But do
Florida.
I feel bad about it? Absolutely not.
Okay.
Because we all have the ability to make excess contributions if we'd like. I think it listed right on your tax return.
Oh, the extra money?
Yeah. So we can all pay extra. So if anyone likes, they can just send the government more money. I think most people. This is how the game. Look, I didn't design the rules.
State of mind I would have to be in to actually check that box and put $1.
That's probably when we'd have some cognitive tests on you, Pat. Pat McLean.
I don't even
voluntarily sent extra money to the Treasury.
Where you could check the box for the election. Do they still have that?
Oh, absolutely. I love giving them money for that too.
That's just
give them some extra money so they can have more. Well, I don't even know what they do with those dollars.
I don't know.
All right. Well, let's.
back to elections. So when I was in
Elections.
when I was in high school, I was taking a civics class in high school, and you had to volunteer. It was through an election cycle. You had to volunteer at some candidate's whatever thing.
In high school.
And they wanted you to volunteer 4 hours or whatever. And I'm thinking, this is crazy. So I go down to the local election office and I said, do you guys think whoever's running, do you think you're going to win? And they said, yes, we do. And I said, are you going to have a big party afterwards? And they said, yes. And I said, I work at a restaurant where I could get all the ice you want. Will you sign off on my 4 hours if I bring in 200 pounds of ice? And they said, sure, no problem.
Did you put in the 4 hours?
Well, I brought the ice.
Well, the time you spent going over there and having the conversation, that took some time.
And then the ice.
So we'll go back to calls here in a second, but we're talking about, so my son was between his junior and senior year in high school, he did a program at Georgetown University in Washington. It was actually a great program for high school kids. So where they did some schooling in the morning, and in the afternoons, he was a volunteer for a congressman.
Okay.
At U.S. Congress. I won't tell you who the person was because when you hear the story, you'll see why. But so part of his job was answering phone calls from constituents.
This kid in high school.
A high school kid. And so after the end of the summer, I said, did anyone ever question your age? He said, oh, yeah, a few times. And I said, well, what would you say? And his response would be, ma'am, that question is really not relevant to your question.
That's pretty good.
And wouldn't answer it. And I'm thinking, here you're calling your congressman.
And you got this high school
and you
kid.
got a high schooler taking your question. In other words,
you just
they don't really care.
pretty much shout into. You can pretty much shout
That's
into
exactly right.
shout into
Might
space.
as well just send an email that no one's going to read as well.
That's
Same
funny.
thing. So anyway, let's continue here. We're talking with Betty. Betty, you're with.
Hello.
Whoa, hi, Betty.
Hello. Good morning.
Hi, good morning. How can we help?
Well, I had a question. I met with one of your advisors the other day just to look at, at investing, of course. And I asked the question, what's better to invest in right now, CDs or treasury bonds?
And for
Which would be better?
how long? Because CDs
A
actually
year.
have 12 months.
Sure.
And so you were in an Allworth office talking with an advisor. And what did the
Yeah.
advisor tell you?
He said, ask you.
Oh, okay. There. So
He said that would be a good
You know-
question to ask.
yes. So the rates are very, very
It's not-
comparable right now.
Here's the main difference between the two. If it's money that's not inside of a retirement account, outside of a retirement account, you live in what state?
California.
Okay, California, high tax state.
And is it inside of an IRA or outside of an IRA?
Outside of an
Okay.
IRA.
So if you invest in a CD, at the end of the year, you get your 1099 of interest that you have to report on your federal taxes and on your state taxes. If you invest in treasuries, it's free of state income taxes.
So if your income is little to begin with, maybe the CD's the best way to go. But if your income, you're paying, you're in a 7, 8, 9, 10% tax rate in the state of California, the treasuries would probably be the way to go.
Okay. Thank you. That answers my question.
Now, in saying that, it's the ease of actually investing, which always, right, that is important to me. So an advisor actually can do brokered CDs, but you're probably not going to get the highest rate on that particular day, although you may, but you're going to get close to the highest rate. So what that means is if I go to NerdWallet, there are banks throughout the United States on FDIC that are FDIC insured that are trying to raise capital, and they will pay a premium on that particular day. And it could be like Bank of, Georgia, Macomb, Georgia, some bank you've never heard of. And it might pay 10 basis points or
That's
15
0.1%.
0.1% higher. But just the hassle of going through that. So, look, if you were talking to me 2 years ago, I had almost all of my liquid cash in CDs. But not today. They're all in treasuries. And
But every situation is a little different.
a little
too.
bit different, but it's pretty much a push.
And neither one of it's going to have any. Whether you use treasuries or CDs, not going to have any impact on your standard of living.
That's true. We're talking.
It's not going to make much difference whatsoever.
We're talking about
What will make a much bigger difference is what percentage of your portfolio you keep in ultra conservative investments like that, and what percentage of your portfolio you have invested to grow for you, and that can keep pace with inflation and offset your living costs that go up.
And what's the answer to that for you, Betty? What percentage of your
me?
what percentage of your portfolio is in equities, stocks?
Maybe 5%. 5%, let's say.
Well, that's not going to keep up with inflation. So the question you asked is treasuries or CDs, and maybe the question you should have asked is my portfolio appropriately allocated so that I can live on it for the next 20 years and maintain my same standard of living?
Okay.
And the answer to that is, at a 5% equity exposure,
Probably not, unless you've got way more money than you need.
do you?
Yes.
Okay, well then do anything you want with it. But even then, if it's way more money than you need, is there a beneficiary that's going to receive this at your death?
Yes.
Okay, let's manage it for them and not for you.
Or
Okay.
some portion.
Or some portion. So I have clients that have way more money than they need. And I will physically...
Not many people feel that way, by the way.
That's
'Cause
right.
whatever that number is, because Betty, we appreciate your call. Whatever that number is, Pat, it's we invest for and save for a variety of reasons. One of which is security.
That's right.
Okay, and money only provides some security, doesn't provide all security. Obviously, right?
Yes.
And so most people, as their net worth grows and their investments grow, when they were younger and thought, if I ever had that much money, I would be completely confident. When they get there, oftentimes they're not quite as confident as they thought they would be. And although they might have more money than they're ever going to spend, they may not feel they have enough money still.
Well, which is why people won't actually give it away. But if they're moderately comfortable that they have more money than I have taken the portfolios and invested them in different accounts in order to have one earmarked for their beneficiaries.
Yes, but people still control it. It's still their money. They haven't given it away.
They haven't given it away.
Yeah, they haven't given.
Yeah, they just know psychologically that the probability of them touching that particular pot of money is little, and so therefore it should be invested for the beneficiary's benefit, not for their own, which means the timeline is longer, therefore you can actually have more volatility in it.
Yeah,
It works. I mean, does it make any difference at the end, the blended return? None at all. But it makes it more palatable for the investor to actually maintain the course.
Yes, yeah. And of course, the challenge with having too much money in just fixed CDs, like right now, you lose money because inflation is essentially running the same rate. Well, it was running higher than cash, and then you got to pay taxes on anything you earn.
So you're net
going
behind.
backwards.
Yes.
You know, it was funny. I was thinking, not funny. It's tragic. I was thinking the other day, with the last 5 years, inflation's been what, 20? Let's call it 25%. I think the CPI is 23%, something like that, of increased prices last 5 years.
A lot.
Housing's probably more than that. If you add in housing, it would be much worse. Let's call it 25%. So if you had $1 million 5 years ago, you need $1.25 million today just to equal what your count. So if your $1 million is now worth 1.1, 1.2, you've gone backwards the last 5 years.
Well, I think most Americans feel like they've gone backwards the last 5 years.
Which is why we often talk about the importance of having things in your portfolio that are going to grow and keep pace and offset inflation.
Well, they help cause inflation. Right?
What?
They help cause inflation. They constantly, if I own an equity it by its very nature is going to that if it's a product,
You own a company.
yeah, they're going to raise their prices
That's right.
until they can figure out what the elasticity of demand is, and then oftentimes what you'll see is they'll overstep it a little bit and then dial it back. But they're
To
one of
see
the
how much
factors of
consumers-
inflation. How much will the
Yeah, well, they're often just responding to what their costs are.
yes.
Are they not?
Yes, but
Yes.
by the fact that they're responding, they're actually helping to they're prolonging the problem. And you own part of that. You benefit from it. It's a good thing.
Inflation's a good thing.
No.
All right.
Owning a
I got
company,
it.
owning stocks in an inflationary environment
sure.
is
Not necessarily every quarter or every year, but over a long period of time. You're not going to have high inflation without increasing
prices.
Yeah, it's just they're going to go hand in hand. So you could have a period of time with shrinking profit margins, which could have a downward pressure on stock prices over a short period of time.
Thank you. Well said. Ask Starbucks.
Yeah, Starbucks has hit a bit of a road bump. Huh?
Yeah. Yep. What you just described there.
I find it, although their app and ease of order and finding a store couldn't be any easier.
No, I'm not.
You never order from it?
Only with my daughter. She'll go on the app and do that. I don't drink coffee.
Well, they have other items besides coffee, Pat. I don't know if you know. They have food items. They have teas, sugary drinks, lots of sugary drinks, caffeinated sugary drinks.
I don't frequent the Starbucks.
I actually use it a lot. Anyway, nobody cares about all your Starbucks use or not unused. We're talking with, I'm going to butcher this name, Doris. Is that right?
Yeah.
Good. Hi, Doris.
Hi.
How can we help?
Hi. So I recently retired from federal service, and I had an
By the way,
IRA.
Doris, you have a very young voice. I thought you were like new college grad or something.
Yeah, I get that a lot.
Oh, do you? Okay.
Yeah. So I had money in an IRA equivalent that I rolled into a mutual fund, and now I want to invest in some sort of ETF funds. But when I do the research, it looks like there's a lot of good ones. I want to do some stocks and some bonds,
Okay.
but I really don't know how to pick.
You know, it's interesting. You came out of a thrift savings plan, correct?
Right.
And
yeah.
you had, 3 choices? 5 choices?
What do you-
Something?
They had more choices now, but yeah.
Not you didn't have a
yeah.
huge menu to choose from, and now you're like looking at this giant menu and saying, "Well, what do I have?" Right? And you said you invested
Exactly.
in a mutual fund. Did you invest in more than one mutual fund or just one mutual fund?
No, just one. I just rolled it over.
What mutual fund did you invest in?
It's just with Fidelity. They're just holding it while I figure out what to do.
Got
Okay,
it.
so they probably have you in like a
Money market
money
account.
market account.
And how much is in this account?
Yeah.
10,000, 10 million, somewhere in between, I'm guessing.
Yeah, well, it's less than 500.
Okay. And how old are you?
63.
So the most important thing, an ETF is just a vehicle where we can get exposure to something that we want, right? So like a stock ETF, they hold stocks of companies, and it's a nice, convenient, easy way for us to buy companies. And ETFs, for the most of ETFs, are passively managed. In other words, there's no team of people analyzing whether these are good companies or bad companies. They're just trying to mirror an index. There are some active ETFs, but they're less common today. The most important thing is not whether we use Fidelity's ETF or State Street's ETF or Vanguard's ETF. The most important thing is what's our allocation? How are we going to divvy these dollars up? What percent are we going to have in large U.S. companies and medium-sized U.S. companies and small-sized companies? And what are we going to have in foreign? And if we're going to have fixed income, how much of that are we going to have in short-term bonds? Are we going to have floating rate in there? Are we going to have government? We're going to have private. What kind of credit risk do we want to take with our portfolio? So it's the construction of the allocation that needs to happen first. And then we say, okay, What's the cheapest way for me to get there?
Well, right. I mean, you're describing part of my problem.
Right?
What's that?
Yeah, that's correct, which is, we don't know what direction to take unless we know where we're going. So,
Well, like for instance, if you want to do like large cap domestic, like there's a bunch of them that all have like Morningstar 5-star ratings. Well, a couple. There's Vanguard, there's Fidelity, there's iShares.
That's right.
And there's BlackRock. That's iShares. But what do you pick? I don't know.
How much money should we have in stocks first? Let's ask the first question. How much money should be in stocks versus in fixed income bonds? So,
I can make an argument. If you're at Schwab, using Schwab's low-cost ETF for their large cap, if you have Fidelity, using Fidelity's large, they're all, if the prices are similar, then it doesn't really matter, particularly if it's in a retirement account.
So are you going to take income from this anytime soon?
Yeah, I'm taking about like $200 a month.
$200 a month in income from this.
Yeah.
So $2,400 a year.
Right.
Yeah, so very little income.
Yeah, and the account balance you said is less than $500.
Have you considered talking to a financial advisor?
Yes, but they all want 4%.
4%?
Or 1%. They want 1%.
Okay. And that's too much.
Well, it seems like a lot. Just to have a few questions answered. I don't know.
Well,
one wanted to do like a big, huge bond tree, and I don't really want that kind of intensive management.
Well, one thing you could do is just pay a financial advisor for a financial plan and an allocation.
Yeah.
They're not going to want to give you an allocation without doing some financial planning because they won't they need to have a better understanding of what you're trying to accomplish.
Okay. Well,
we didn't help.
I just thought, what's that?
We didn't help because what we told you is you need someone to help you. You need someone to help you find out what you want.
Yeah.
Now, here's the reality. So, Doris, I really appreciate the call. I've been a financial advisor for 3 decades. There's nothing that can convince me that Doris would not be better served working with a good financial advisor.
No question.
Right?
That's
I'm
right.
convinced to my core.
That's right.
And the longer I'm in this industry, the more convinced I am of the value a great financial advisor can bring.
Correct.
It's because it's not just it's picking
part
is
of the
part
allocation.
Of it.
But do we do Roth conversions?
It's not, and it's a lot of it. It's of course it's all integrating with how do we minimize our taxes. There's some tax loss harvesting we can do, those sort of things. But so much of the value is that guidance that happens not when things are rosy, not when life's going normal. That's easy. Market's going up month after month. Those are easy times. It's when there's a financial shock, financial crisis.
Scott,
right?
I'm going to disagree
market.
Because when it's going up, a good advisor is not letting the client get caught up in it.
Making sure they rebalance because whatever happens, I don't want to sell. I don't want to rebalance now.
Right.
Things are going so well.
Yeah, if I come in with a 70-30 portfolio and next thing it's 85-15 and the client's like, well, why would you get rid of the things that are doing well?
And it's also those times when life happens. Suddenly our adult kids move in with their kids and your household expenses go up for a 2-year period of time. Well, or we have a terminal illness and all those other things. Frankly,
I get it, Scott, but
picking the ETFs,
but the 1%. I can't answer that question. I just can't. I don't know enough about you. I don't. Right? What I'm going to tell you, do the BlackRock iShares and the Vanguard Total Market, and then goodbye. Have a great life.
Well, when you have companies that have ads with little babies making stock trades, in other words, it's so easy a baby can do it.
The baby can make the trades. We're going to agree with that.
Okay. Let's talk now with Arthur. Arthur with Allworth's Money Matters.
Oh, how you doing today? Thank you for taking the call.
Yeah, glad you called.
So if you were fully invested in 30-day treasuries I've been just keep rolling them. Didn't need the income. Or in your late 60s. How would you barbell a strategy if you don't need the money going forward, given interest rates are a slam dunk?
So here's that's a funny question. I wouldn't do that strategy to begin with. So not to be flippant, but
it's been yielding me more. Actually, the difference between a
I
30
understand.
days 5-3. I've been taking the risk. I heard that's what rich people do, so I'm read that mirroring the rich, and I know I'm supposed to be allocated and all this other stuff, but I lost it all when I was younger. So
Okay.
I'm at the point in life where, half my money's in California real estate on the marina. So that's a high risk asset.
Yeah.
So I'm balancing, yeah.
Okay, and then the rest of the assets are in treasuries?
Yes.
And it's
About
been
$1.6 million in treasuries.
all 30-day treasuries.
Yeah, I've just been rolling 30, 3 months, 30. I've been balancing off and on, but
How long have you been doing this?
about a year.
Yeah.
And
where
what were
was the
you
money
doing before?
I'm sorry?
Where was it before a year ago?
It was in mostly stocks and longer term CDs. I'm just getting more conservative as I age.
How old are you?
69.
Are you married?
No. I get about 50 grand in Social Security. I waited till, late.
And I assume you have no debt.
No, no debt.
Do you have any debt on any of these rental properties?
No, I don't have any rental properties. I just have one marina property on a private island surrounded by yachts.
Are you
Okay, so
living on it?
Yeah, I live in
Okay. It's not an investment then. You're actually
No,
consuming
it's not
it.
an investment. That's my home, and I don't intend to sell it. 'cause
Okay.
I get
Yeah, sounds
killed.
nice.
In a marina,
Yeah.
private island.
Yeah.
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 Sign me up.
Yeah.
Sounds good. Good for you, Arthur. So, and I apologize for maybe I didn't listen to your question enough because if you were doing this, so you've been using 30-day treasuries, and your concern is, my guess, that rates are going to be reduced, and now what should you do? Is that your question?
Yeah,
essentially?
rates are going to reduce for sure. So it's how fast. So like I said, each percentage, I looked at this morning, I get about 5.3 on a 30-day and about 4.3 on a 1 year.
Yeah, and the longer you go out, the lower it is, right? I mean, 10 years.
Yeah, and if you go down to 2 years, you're at like 3.5.
Yeah, it's an inverted yield curve.
But what we don't know is that it could be that 6 months from now, short-term rates are at a percentage or 2 percentage points lower, and long-term rates could be higher. We don't know.
He's asking us. Essentially, you're asking us to predict where interest rates are.
We have
going to
no
go.
idea where they're going to go.
We have.
Well, a conservative. So just as an example, I bought a year ago to learn some 20 years. They were at 4% with $250,000, and I was down 50 grand in a month. That's
you could have been down much worse than that. A 20-year treasury is long.
So I knee-jerked it, and luckily I got out with a little loss.
Well, yeah. I would consider going the same strategy you're going. What you just said to us is you are completely risk adverse.
At this point, I'm going to die with money unless something really bad happens, so I don't care.
Okay. You're completely risk adverse. I would have argued with you when you were buying that 20-year. Did you sell that 20-year?
Yeah, what had happened is my gut wasn't right. It jumped too much, so I sold out, and then I bought it back later, and between the two of them netted just about $1,000 profit.
Okay, and you waited 30 days before you bought it back, I trust. 31 days.
Yeah.
Okay.
Yeah. It was down, at the worst, it was like $1,000 a day for a month.
And you own a 20-year treasury right now?
No, I dumped it all. All I have is 30 days and less.
Look, if I was risking,
And you're a resident of California.
Yeah.
So the nice thing about treasuries, you don't have to pay California.
No state tax, exactly. That's another good thing.
I have some money on the sidelines right now because I expect a capital gains tax to come due sometime in the next, for me, 36 months. So I've got some assets that I know are going to be sold in the next 36 months. So I've set aside some money for capital gains. I actually don't even buy treasuries. I just put it in a high yield money market account that's FDIC insured.
You can also buy an ETF, like I don't know who the manufacturer is, but there's one
that
BIL, and it's
and it
I don't know if
rolls.
it's 30 or 69, and it does it all for you, and it's cost you a few basis points or something, but it's you don't have to think about it.
I would do one of those two things, or the strategy that if you want to be involved in
I
doing
would not buy any long-term treasuries.
I wouldn't go out more.
The swings on them are massive.
Yeah,
No, the swings are massive. Yeah,
that's right.
And
I like the 30-day or the bill, the ETF, or a high-yield money market account. They're not forgiving much by putting it in a high-yield money market.
Not these days.
Not today.
No, I've done that, and they're not even giving you back the tax that I'd have to pay in California.
That's not true.
But you can do a treasury money market.
That's not true. You can do Treasury. So
That only invests in.
where is your money in a big brokerage firm?
Yeah, it's all in Fidelity.
Okay, so you look. They use, actually. There's all kinds of lawsuits about this right now. You have a cash sweep program in there that you've elected that. There is a menu that they have at Fidelity that will get you exactly where you want to be with short-term treasuries or a similar product. It might be called something different, but it's backed by short-term treasuries that yields every bit as much and is easier to do. Or just continue on your 30-day thing.
Yeah, I would not.
Okay.
I definitely would not do any long term. So I appreciate the call. Hey, let everyone know we've got a good webinar. Like, we're big on education. That's why we've been doing this radio show podcast for almost 3 decades, and lots of good information on our webinar on our website. We also have a webinar, the Essential Financial Planning webinar. And it's just 40 minutes. You're going to discover some tips to boost your savings and also watch your financial cushion grow. You'll learn to effectively navigate taxes so you can keep more of what you've earned. And you're going to find out how to protect your investments and achieve long-term growth. All in this 40-minute. Well, you're going to obviously learn quite a bit.
Quite frankly, and Doris would benefit from attending
It's
this.
free. September 18th, September 19th, September 21st. Those are the 3 dates. To register, go to allworthfinancial.com/workshops. It's been great being here with you. Scott Hansen and Pat McClain of Allworth Money Matters. We'll see you next week.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.